Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We are talking today with Angel Martin Oro, Editor-in-Chief of Investia.com, a financial market analysis and news website based in Spain. Angel, welcome.
Hi, Andrew. Thank you for having me.
So, Angel, tell the audience about your background and tell us about the work that you're doing at Investia.com.
Yeah, well, I studied economics at university, and there I became very interested in quite a few areas in economics, also investing to a lower extent. And in my university, I tried first to develop a theory about economics in a wide sense, and I also became acquainted with Austrian economics, which is a school of thought quite outside of the mainstream of economics. And after my university degree, I tried to develop an academic career with a PhD. I started a PhD in economics, and I first focused myself on topics like entrepreneurship, economic growth, economic development, also education policy. But afterwards, I realized that it wasn't for me. About that period, I became much more interested in investing and in the financial markets than I had been interested in the past. So I realized that it wasn't for me, and that's when I started to work for Investia, which is an investing website. And I also give some lectures in a couple of postgraduate programs related to the economic structure or the economic environment for growth, and also related to investing more in general. And I'm also the writer of a biannual report on the Spanish economy.
So, Angel, I think that's a good background. I think that economics and finance are two core pieces of anybody who goes through the educational system, no matter where you are in the world. I think that economics and finance should be a core study and taught by people who have real life experience in it, and don't just teach theory, but teach real life economics, real life finance. I think that's really important. Moving on to another question, what is your view on the energy situation in Spain? And can the Spanish infrastructure going forward support a move away from nuclear power at this point in time?
Well, I think that the recent news about the energy landscape in Spain are quite telling, because the socialist government is quite against nuclear energy, and their ideology is quite against it. And they are ideologically, they are leaning much more towards renewable energy because of the green impacts and the allegedly benefits that it has over the environment. But it's very interesting what is going on, because while they're ideologically against nuclear energy, they are kind of admitting that it's very difficult to do away with nuclear energy. And I think it would be a very good lesson, a very good exercise for the Spanish government to admit that they will have to do away with nuclear much later than they would like to, because nuclear energy is a very useful part of the energy grid in almost every country. And if you have the infrastructure already built, if you have the costs, the upfront costs, you have it financed already, I think you should go on with that. And I don't think it's a sensible policy to do away with nuclear, because renewable energy may be a very good energy source in the future, but you have to complement that source with other base load carbon-free energy sources like nuclear. And I think also the case of Germany is also quite telling, in the sense that they want to do away with nuclear too, and they have found that it's very difficult to do it without restarting the carbon emissions and the carbon energies, the carbon as an energy source. So I wonder why the German government isn't planning to continue with nuclear. And I think, I mean, it may be a political thing, not a technical one. It is one of the examples where ideology trumps the objective data and objective stuff that the technical stuff that the government should base on.
Right. I think that some of them think, why should the facts get in the way of a terrible idea like shutting down nuclear plants in Germany, only to turn around and just go buy it from somebody else like France? And it's just nuts. There's already enough energy problems with relation to Russia's supply of natural gas to the region, and Russia's kind of stronghold on choking off European energy. And here you have some of these dumb decisions that get made about shutting down perfectly good operating plants that are in perfect condition and continue to operate and provide carbon-free energy. It makes no sense to me why you would do that. Completely stupid. And of course, there's another example in California. Diablo Canyon is another one. Perfectly good infrastructure, perfectly good piece of equipment, not bothering anybody or anything, operating just fine. And yet California government somehow thinks that they're smarter than a nuclear utility is. And so that's just absolutely crazy. So two things. There's two companies I want to talk about just briefly in Spain. Iberdrola. I remember they had some projects, expansion projects globally. I remember some projects out in Oregon where they're expanding and doing solar panel projects in the United States. What's the role that Iberdrola has in Spain today? Can you kind of share us a little bit of information about the company and kind of what they're up to?
Well, they are one of the two leading utilities in Spain, and they are focusing on renewables and other sources of energy. But I don't closely follow the company, so I'm sorry I can't give you much information about it. But I know that they've been very focused on renewable energy for quite a while, and since one or 2 decades about it. So they are one of the leading. The other one is Endesa, and they are the two leading utilities in Spain where we're providing electricity for the users.
So the other one, we've gotten a little bit of news on it. We're not sure how it's going to turn out, but Berkeley Energia, with their project to try to develop a uranium mine in Spain, Salamanca. What's your view? What's the public view on this? What's your view on it? And do you see this actually going forward anytime soon, or do you see this continuing to be held up in the red tape of the government?
Yeah, well, they're facing a difficult situation there because, there are no uranium mines in Spain, and as many experts on the topic say, as an investor, you have to focus on countries, on jurisdictions where uranium mines have been built before, and if you try to do it in a country like Spain without any uranium mines, I mean that's dangerous because on the one hand you have that sentiment about nuclear energy that we talked about before, the ideologically view against it, and then you have also the sentiment against mining, because mining is it's not environmentally very friendly, although it's quite essential for maintaining our standards of living. But given the negative sentiment for both nuclear energy and also mining, and which is more exaggerated for uranium mining, I think it may be a bit difficult for Berkeley Energy to succeed. Although, I mean, I'm not with this political stuff, with this political red tape, you never know. But I would find myself too risky to bet on this project. And I haven't visited the project, but I have a couple of references from two people I trust, that they have told me that it's not, it doesn't look like a very attractive project, that it's just a piece of land and very little else. So I personally wouldn't bet on Berkeley Energy, and the political risk there is quite elevated. Although, I mean, the reward can also be very big if the political red tape resolves itself in a good way for Berkeley.
Yeah, I agree with you that it's going to be big time challenges, and with that, there's just so many better opportunities to take a look at on the global stage. I mean, I would, if I was a betting man in this situation, I would rather place my bets with a Supreme Court case outcome with Virginia Energy Resources than try to bet and deal with the Spanish government. It certainly has a history of most certainly in modern times here been very difficult to get anything done in relation to mining, and it's too bad because it's such an important critical piece of our advanced economies worldwide, and everything we do. We need to have mining, and we need to be able to grow things. So if you can't take it out of the ground and you can't grow it, we're pretty much you might as well just plan on doing something else, because right now we have to have both of these things, and they're absolutely critical to our way of life and
Sure.
everything that we use on a daily basis. So I think it's really important, and it's interesting what's going on there with Spain. So looking at, we already kind of touched on a few things with related to Europe and nuclear sentiment. Flipping to the kind of the financial side with regards to investment in mining and specifically uranium, can you tell us about some of the institutional investors that you're aware of in Spain and nearby that are looking at uranium investment at this point? Can you give us some names and maybe what they're focused on?
Yeah, sure. I mean, there are a few Spanish fund managers who are finding uranium quite attractive. And the first one and the biggest one is Advalor Asset Management, which is a value-oriented boutique that was founded a few years ago. But the fund managers have a 20-year experience investing, and they were working in another fund management company called Best in Bear, but then following the exit of the leading fund manager there, Francisco García Paramés, who is a very well-known investor in Spain and also in Europe, they parted ways, and they found two different asset management firms. And here with Advalor, they have been invested in a few uranium companies for, I would say, for 1 year or more or less. And their main investment in the uranium space is Cameco, which is like about now 7% of the portfolio. So it is a quite big position for them. They've also invested in Uranium Participation Corp for a while, for 1 year more or less, but it's a quite small position, like less than 1% of the portfolio. And then they are also invested in Yellowcake after the IPO. I think they were one of the IPO investors there, and as it is a very a very small cap company. They have a very small position, like have a percent in the company, in the portfolio. But I think they are one of the big investors there, like having some 5% of Yellow Cake company. And then their last buying in the uranium space was NextGen. Like, I think it was in the fourth quarter or the third quarter. They bought a small stake in NextGen. So all in all, they have about 10% in the uranium investments, and Cameco is the first one. And they are, as I said, they are a big investor here in Spain, and perhaps what big means is different in Spain as in the US, because here in Spain they have about 1 billion with a B of assets under management in the international strategy, which is a very big independent asset management firm in Spain. And they also are very positive on natural resources in general. They have about 60% of the portfolio in commodities related companies. So this is very interesting for me, because it's not that they are an investor focused on natural resources traditionally. They are generalists, and they have invested mostly in Europe historically. So it's quite telling that they are finding a lot of value in the commodity space and in the uranium space particularly. And then we have a few smaller investors that are also betting on uranium. We have a small SICAP, which is called Salmon Mundi, and they are also value oriented, but they have a more global macro view too, and they have also about 10% of their portfolio in uranium investments, both in Denison Mines, NextGen, and also in Uranium Participation Corp. But this is a very small vehicle, like 10 million of AUM. And a third vehicle is Oros, from the asset management firm called Oros, with H. And this is they have an Iberian fund, but the international fund is the most interesting one for me and for uranium. And they also have about 8% of their portfolio in uranium through Uranium Participation Corp and Yellow Cake. And they are quite conservative here, and they prefer not to invest in uranium miners because of the execution and operational risk, and also because of the fact that the uranium thesis might take longer than we expect to play, and in that scenario the uranium miners might suffer. So they prefer to invest in the physically holding vehicles. And this is also very interesting. This vehicle is I mean, I am personally invested in this one, and also in Valor Asset Management, and I think that they are very good managers. They are also generalist, so that makes it even more interesting. The fact that they are invested in a very small, hidden, opaque, and niche market like uranium, and they are also finding more value in commodities other than uranium. And we also have Alterius Capital with Prime Value Fund. They are from Gibraltar, but this is a fund that is a bit different from the others, because this is not as accessible to retail investors as the previous ones. But they are also very, very positive on uranium. And I think the last one that comes to mind now from Spain is a very small fund, which is like 4 million euros of assets under management, and they have invested in a few of the uranium miners. They are invested in Paladin Energy, in Energy Fuels, and I think Denison too. And it's about 6% or 6 to 8% of their portfolio is invested in uranium. So all in all, I think this is pretty interesting. The fact that neither of these funds are uranium focused or commodities focused investors, and I think it's quite interesting about the attractiveness and the potential of the uranium market and uranium investments to because as I said, these are generalists, and they are focusing on uranium because they are finding a lot of value there.
Right, and I would also mention out of Liechtenstein, Incrementum AG is another larger fund that's based not only in natural resources, but also does have some stuff going on with uranium. So, Angel, do you think a lot of these funds, do you think a number of these funds at this point are starting to actively pursue some of these companies, perhaps contacting them directly, looking for private placement opportunities to possibly accumulate more shares as these companies need more funding, in 2019, 2020?
Well, I don't think so, because these are retail funds. These are funds open to retail investors. So I think that in their internal norms, in their regulation, I don't think they are allowed to pursue at least in a big way. So I would say they are not very open to that kind of investments. I think they are more interested in open market and listed companies and not private placements. Although, I mean, I don't know. I hadn't thought about this, but I think their focus is on listed companies.
So what are your thoughts on portfolio strategy with regards to uranium? How are you structuring your own portfolio in this regard?
Well, my own portfolio, perhaps I will give you a flavor of my portfolio outside of uranium, because uranium is a part of my overall portfolio. Which yesterday I was running the numbers, and uranium related investments are like 15% of my total invested assets, and I have a bigger part of that is invested through mutual funds, like the ones we talked about, and the other part is invested through shares, through individual stocks. And in that particular segment of my portfolio, uranium investments are like 35% of my stock portfolio. So it's a big part of my stock portfolio, but it's not a dominant part. And within the uranium portfolio, I am currently more focused on the U.S. Because I think the catalyst of the Section 232 is quite interesting to play, and also because there are at least a couple of producers there that are quite interesting. They are low cost, and I think they will enjoy, and they will behave very well in a rising market, but they would also stand with a market that doesn't rise as rapidly as we would like. So I'm currently focused on the U.S. producers, and then I also have a couple of Canadian plays. One is Cameco, and the other is Denison. And also my biggest position in my uranium portfolio is Yellow Cake, because I think is the safest play, and it's also the one that requires less time to follow, because it only depends on the macro picture. In contrast, the uranium miners, you have to dig a little bit deeper. You have to follow the news closely. You have to do some research on them, and I think for me it's quite difficult to do that, and yeah, it's also I would also like to point out that I'm mostly a second-hand dealer of ideas, of investing ideas. I have very little time for a deep due diligence in both in the macro picture and in the individual stocks. So I try to be selective with my time dedicated to the uranium space, and because I mean, retail investors like me, we have a job, we have a family, and we can't spend a whole lot of time with researching this stuff, and I try to be active in this space. I try to read as much as I can, and I'm also invested in a few uranium miners, as I said, but yellow cake is perhaps the easiest one, and although it may have the less upside compared to the others, but it also has the less risk. So this is more or less how I'm framing my uranium portfolio. But even I said that I think that also there are other plays that may be very interesting, like plays in Africa, but I'm not used to. I'm not yet prepared to do that. I haven't done enough due diligence there. I would like to research more on that, and I think your nuke report will be very interesting to read, because I'm sure you will provide a lot of interesting insights on the African plays. But I feel I need more time. I think I feel more research to buy into those plays.
Right. Yeah, and I think that there's as we continue down the road here, we have more and more time to discuss, review, and investigate these companies, and that's a good thing, because as the market allows us to have more time to look at them without them taking off anytime soon, you kind of get a chance to review again, twice, 3 times, 4 times, look over the same stuff and come to decisions that maybe you didn't make, or maybe you didn't have the same outlook, say in 2016 or 2017 when you first looked at the space. And so with the different catalysts worldwide that are taking place, I think that, people need to look at the U.S. Section 232 catalysts. The U.S. has everything from producers down to explorers. So you have that side. And then, of course, looking out beyond the U.S., you have Canada, you have Africa, and you do have some stuff going on in South America, Central and South America. And so I think that, folks can begin to strategize on how they blend their portfolio with a mix of different types of catalysts, whether it's timing, whether it's Section 232, timing being maybe that there's a play or two in Africa that could potentially come online, develop, and produce during the cycle, whereas maybe timing in a Canadian play may take many years to play out, 4, 5, 6, 7, 8 years, whereas maybe in Africa it's maybe only a 2 to 3 year time frame. And so I think people need to look at a complete suite of different ways to blend a portfolio. The holding companies, like you mentioned, Yellow Cake is probably our favorite when it comes to the holding companies. So I think that there's a blend. You look at speculations, you look at developers, you look at different countries for timing purposes, you look at Section 232 catalyst companies. I think there's a lot to be considered, and of course, we're not perfect in our recommendations, but we think we've got a pretty good handle on it. And, it'll be interesting to see how things play out as Section 232 comes down, hopefully this year. And there's no further disruptions on getting that off our desk, and then going from there, looking at long-term contracting and so forth. So you mentioned a couple companies, so I won't twist you too much more on that side. But what other investment opportunities are you looking at, maybe outside of uranium at this point?
Yeah, well, I would also like to add that I'm quite new to the uranium and commodity space, and I started to get interested in uranium in 2018. So I've tried to read a lot, but I'm just a newbie here. So I think I have to learn a lot more about junior mining, about mining in general, about uranium. But I think that we retail investors have a kind of we have been benefited by the research that other people have done, like Mike Calkin. I mean, he is my favorite source in the uranium space, and I've learned quite a lot of things through him. I've listened to a lot of his podcasts and tried to read or listen to everything that he published. I even interviewed him at Investia, and I also published an interview with him at Seeking Alpha. So your listeners can read it. And I think we have benefited a lot by those people. And I think that the macro picture, I wouldn't say is clear, because there are also uncertainties, but I think that the macro picture is quite solid. In the individual stocks arena, I think it's more difficult to have a strong view, because as I said, I'm not I haven't been in this space of commodities and mining for a long while. So I'm trying to learn fast, but it's not enough. So yeah, you asked about opportunities. I will also mention a couple of U.S. plays. I'm also invested in energy fuels, which I think is perhaps the best one in the U.S. I haven't invested in the smaller U.S. plays, the ones like Encore, Appiel, Laramide. I'm not there yet. Yeah, it might take me some time to get there. Perhaps I would first try to study a little bit the African plays like Paladin, Govix, or Deep Yellow. And in the US, I think I have enough exposure. I have also exposure to UR Energy, which I think may be an underappreciated company. This one has been cash flow positive in the last few years, and people will talk about it much less often than energy fuels, and I think they are well protected with their contracts until 2021. So they might behave quite well if the uranium thesis doesn't play out as fast as we would like. And then I think I also have to mention that I am still invested in UEC, which I think we have talked about it sometime. And yeah, well, I think it might be a mistake from my part, because it was the first uranium company that I bought when I started to research on the sector, and I found it that they have quite a lot of upside, that the management seem to have the skin in the game. Amir seemed to be invested in his own company. But I mean, as time has gone by, I've realized a few things, and these haven't been as pretty as I first thought. But yeah, it might sound a little bit contradictory, but I'm still holding my shares, perhaps because I think there may be a lot of upside in a favorable Section 232 resolution, and also because at these prices, I don't think the downside might be much higher. So I'm still holding, although I'm not very comfortable, and I might sell it when I find a best alternative.
Well, sure. I would just say that for us, you never stop learning, and it doesn't matter if you've been in the business or researched, been in natural resources for 40 years, 30 years, 10 years. It doesn't matter. For us, we've studied natural resource sector here at SmithWeekly Research, kind of officially and heavily in 2015 onward, which proved to be fairly good timing with regards to what happened in 2016 across the natural resource space. And then, of course, prior to that, I had been involved with the sector personally from an investment standpoint since about 2009. And so, it's been a long time going, but we still, every day, we learn something new. And as time goes on and as we study more and more, we tend to form opinions and methods on how we evaluate these companies. And then, of course, throughout that time period, we also would see where our thoughts before have changed. And so our opinion changes with facts, new facts that come out, new information that comes out, our opinions do change. And I think that when you look at the particular companies you mentioned, in the States, the three big kind of production-ready companies are the energy fuels, the UR Energy and Uranium Energy Corp. And when you look at those three companies, as I've said before, they all kind of stink, but there are, Uranium Energy Corp does stink more with the way it's kind of set up. And whether or not that's intentional or not, I'm not sure. But the other side of that is, speaking in favor of it, all of these companies are listed on the New York Stock Exchange. They have a lot of liquidity compared to other companies, and they're going to be, all three of them will be some of the first companies to go up. And with that, it's all about price. And if Uranium Energy Corp is cheap and is cheaper and cheaper, then it's about price. So if you can buy this company at a low price, your risk is reduced. Even if maybe it's arguably not very well managed, you can still do quite well making money if you get in at the right price. And that is everything in this sector, is all about price and more. And so if you can get in at the right price when sentiment is low, you can do well. And on top of that, too, these are the three games in town, speaking of the United States. So each one of these companies will go up. I think at this point, the only debate is which one will go up more. So whether we don't cover Uranium Energy Corp anymore. We sold it, I believe, in October 2018 for a gain. But if it gets cheap enough again, we would look at it, irrespective of what management does. If it's cheap enough and the company maintains its New York listing, we would consider looking at it again if it gets cheap enough. So I think that folks that picked it up at a low price are probably going to do well. So I think you kind of have to put those different aspects into perspective when you look at these companies. Now, you also mentioned UR Energy. This company has some room to run. If you look at the market cap of this company compared to Energy Fuels, this company can literally double in price, if not more, and still be a smaller market cap than Energy Fuels. And so I think that UR Energy is another value proposition that can potentially do quite well, and it has a New York listing. That's kind of my 2 cents on it, Angel. I think that there's a number of pieces that need to go into the consideration. So outside of the U.S., is there anything else that you kind of like with uranium companies? And then after that, if there is anything, what other sectors are you looking at outside of uranium that you like?
Well, outside of the U.S. in uranium, I think the Canadian place I am also invested in, like Cameco and Denison mines. Well, I think Cameco is the one play that one has to play if one has to wants to have exposure to the sector without having a big risk. Although the upside is not as big, but I mean I think that a blended approach to the uranium portfolio is good, and they also have as Tim, as the CEO of Cameco said yesterday, they also have quite a good of an upside in the US if Section 232 comes up in a favorable manner. So they also have some US exposure. And then I also wanted to be exposed in the Athabasca Basin through Denison Mines, because They are, I think, they are very well managed. They are part of the Lundin Group, which is not a guarantee, but it's perhaps the best as it gets. And they are also very low cost. If the PFS if the latest PFS is valid, they are very low cost, and they, although they will not be producing until 5 years on the road or even more, but I think I want to be exposed to the developer space, to the developer subsegment, and also in the Athabasca Basin, which is the go-to place in the world. And as I said, I would like to look at the African place, but I think I need much more time. And then outside of uranium, I think in these sectors that I'm going to mention, I only have an intuition. I haven't well researched them. And as I said, I'm a second-hand dealer of investing ideas. I track a lot of fund managers, and I try to get an idea of where the opportunities may be. And but I think that the oil sector may be a good opportunity. Perhaps the exploration and production, I don't know, but perhaps in the offshore oil services, I think that demand will have to grow, because it's a big chunk of the oil market, and only with the onshore, with the shale plays, the oil supply will not be enough to satisfy the growing demand. So I think in the oil space there might be some good opportunities, perhaps in offshore contractors. And I've also seen some of the fund managers that I spoke about. They are also positive on this subsegment. They are long ENSCO, for instance, or Diamond, or Transocean. And also I'm getting interested, and I've been getting interested in the shipping space. And I also own a company that has done very poorly in the last year. It is the TK Group, and this still is a very big bet of one of the biggest independent asset managers in Spain, Cobas Asset Management, I mentioned before. And this is a holding company that has 3 daughters, that has one, the main and the biggest daughter of this TK Group is TK LNG, which is dedicated to the transport of LNG to the world. And this is a very, I think, a very robust value proposition, and they have long-term contracts for shipping LNG, and they have been investing quite a lot of money in the last few years, and their growth projects are almost done, and the only thing that is coming up is the cash flow from those investments. So I think that those cash flows, when they arrive, which is very soon, I think they will show that the company is very cheap, and this also will benefit the parent company, TK Corporation. And they also have a daughter that is TNK, TK Tankers, which is oil tankers. This is one of the worst segments of the market in the recent years, but it might be a good bet on in the following years, perhaps the shipping segment and the oil tankers. And the other daughter of the TK Group is TK Offshore Oil, which is the ticker TOO, and this is partially owned by TK only, because Brookfield Partners entered there, and they are managing the company now, but it is exposed to the offshore oil market. So I think by owning TK Corporation, I think I am exposed to a few trends that I'm interested in, like oil tankers, like LNG growth, and the offshore market. And I think this may be a good opportunity. I've been invested here, unfortunately, for a while, so I have a loss that is quite big, but I think it might be a very good opportunity down the road. And then also I'm interested in the auto sector in Europe. The sector has been wildly punished in the last few years. There are a lot of doubts regarding the risks about disruption, about the electric vehicles, about the autonomous vehicles, about the economic and business cycle. There are a lot of worries there that I think they're mostly or even more priced in the stock prices. So I think that the sector is quite cheap, and there are also very interesting companies, very cheap companies, and I think that the sector may be a very good bet if you believe that the European economic cycle is not going to go through a very sharp recession and only a slowdown in growth. And I think and even if there's a recession, I think the stocks might have already priced that in. So I think they might be also a good opportunity.
Well, yeah, I think you mentioned a number of opportunities that are certainly due for a reversion to the mean, and so I think the sentiment is so low in those areas that specifically in the shipping, offshore services, oil and gas space, I think a number of those have some catching up to do at some point, and I think that those, while volatile, will probably have a time in the sun again, and certainly it's kind of a when question with some of those. The sector is consolidating quite a bit, and there's been some tough times already in the past, and of course prices continue to remain low. But I think that there is some potential opportunity in the future for that to take back off and maybe get back to the mean. So on another subject, what do you think? Where do you think the big market is headed in 2019? Do you see that the markets are going to hold up, specifically in the U.S. and Europe, or what do you see going forward with the big market?
Yeah, well, that's a very complicated question, and the prediction of markets in the short term is a pure speculation. But I will try to give you a flavor of my thoughts about the overall market. And before that, let me tell you that in my personal investments, I try to be as a value focused investor, but I also have a wide interest in the global macro picture, and also in other investing styles. So although I mostly value, I'm mostly trying to pick stocks both through my shares and then through different mutual funds, which do it for me. I also have a global macro view, but I find that it's a bit difficult to apply a global macro view into investing, because first of all, it's very difficult to predict global macro trends. I mean, it's very difficult to be able to anticipate yourself to a slowdown in growth. And perhaps you may see the data, the leading indicators that are slowing down, and but you can wonder, is that already priced in the markets? And you may wonder, well, those data are public, so investors must already know them, and they have and they should have already priced those data in stocks. And I think that the second level thinking that Howard Marks talks about in his book, The Most Important Thing, he says that the obvious things in investing may already be irrelevant, because the market already knows them, and they are already discounted in the prices. But sometimes I have the feeling that it is the obvious things that we may overlook them, and we may think that the market is more efficient than it really is. And I think that perhaps the 2015, 2016 slowdown in growth, that the market was going crazy because there was going to be a global recession. But if you looked at the data, the recession in the developed economies was almost only in the energy and mining space. But if you looked at the overall economy, the data were still solid. And you may wonder, well, is the market full? I mean, the market isn't full, but sometimes you may get that feeling. And with the overall market, I think last year, in the last part of last year, I think we saw an irrational sell-off. I think it was irrational because the market was trying to anticipate a recession that hasn't come up yet. And I think it was mostly irrational. Of course, there are risks. There are always risks, but I think it was irrational. And sometimes the market tries to anticipate and tries to predict a recession. And if you look at the history, the track record of the market predicting recessions is not very good. So you have to have an independent view there about the economy and about the markets. And I think that the markets, the overall markets, gave a very good opportunity to buy into stocks in the latter part of 2018. I tried to do that, but I have to say that the timing is very hard. And when the market had already fallen a bit in early 2018, I tried to buy some stocks and I found that I was too early. But I think that the latter part of 2018 was a very good opportunity. Now with the rebound that has already taken place, I'm more neutral short term, because I think that one has to be vigilant of the macroeconomic risks. I don't see a recession being imminent in the global economic space. I think that we will see a slowdown and perhaps a recession, but not imminent, perhaps in 2020 or something like that. And I think that one mistake that investors make is just trusting their investing ideas in the years that the U.S. bull market has taken place. I mean, we all know that is very long in the tooth. That is like 9 or 10 years of a bull market. You can say that it's hard that this continues. Of course, this will not continue forever. But we already had a 20% correction in the U.S. markets, and we already had a 20% plus correction in Europe in 2018. We had a 20% plus correction in Europe in 2015 and 2016. So I think, especially in Europe, I don't think it's overstretched. I don't think we can say that the bull market has taken very long. I think that there may be very good value opportunities there, and you have to take into account the macro risks. But I think that already in some segments of the market, in some sectors like the auto market that I mentioned before, I think they may already discount a recession. And so you will only have to a slightly better than expected environment for these stocks to behave well. And if you have that pessimism discounted already in stocks, I mean, I think that you may do very well in this particular segments of the market. And regarding the overall market, I'm neutral now, but I think that perhaps the time has come for active management, for picking stocks, and perhaps for natural resources to do well, because there's also a very serious risk, at least as it's perceived by the market, that we are in the late cycle stage of the bull and the expansionary phase of the economy. And that may be true in the case of the United States, and also in the case of the MSCI world, which is mostly the US. As I said, I think I have a hard time finding that thesis true in the case of Europe. And that said, I think that Europe has quite ample room to grow, and the US may be a little bit more stressed. But I think that some of the technology companies, I don't share the view with a lot of natural resource investors that these stocks are kind of a bubble. I mean, I don't know why, but you find a somewhat positive correlation between the extent that one invests in natural resources and the extent that those investors believe that technology is a bubble. I think there are some stocks that may be in a bubble or something similar, but I think that the likes of Facebook or Alphabet, I think they might be in a good position and even in a cheap price for these stocks to do well in the future. So, and given that these stocks are a very important part of the U.S. market, I'm not pessimistic yet on the U.S. market, and especially after the correction in 2018, I'm not negative about the market.
Well, I appreciate your view on the markets, and you covered a lot. Our view is just cautiously optimistic. The 10-year anniversary for the United States is this March, so we're going on 10 years. So we would just say, short of natural resources and uranium, we say cautiously optimistic going forward. Make sure you have cash, and we'll see what the Fed does next as far as their monetary ideas, and we'll go from there. So you're on Twitter. How can people best get in touch with you?
Well, yeah, my Twitter handle is _Martin Oro. I will spell it _MARTINORO. That's my Twitter handle. I'm very active there, although I mostly publish in Spanish, but I also try to publish some things in English. So I'll be glad for you to follow me.
Yeah, and the audience should reach out there on Twitter. You're pretty active. So Angel, we appreciate the time you took today to talk with us.
Thank you for having me, Andrew. It's been a pleasure.